High-yield investments promise fast profits and tempting returns. But what most investors forget is that high yield almost always comes with high risk. In 2025, as markets shift and interest rates remain unpredictable, more people are chasing yield without understanding the dangers behind it. What looks like easy money can quickly turn into unexpected loss. To protect your financial future, it's important to know what truly lies behind those high numbers and glossy offers. 10. The illusion of guaranteed returns. Many investors fall into the trap of believing guaranteed high returns exist. Scammers and risky funds often use that illusion to attract new money. The truth is, if someone promises above-market yields with no volatility, they're likely hiding the risk. Financial markets don't offer rewards without exposure to uncertainty. When you see high returns with little explanation, treat it as a red flag, not an opportunity. Real wealth is built through consistency, not by gambling on promises that sound too perfect to be real. 9. Interest rate volatility hurts more than you think. When rates rise, the value of bonds, dividend stocks, and other yield-based assets can drop fast. Many investors forget that yield is tied to interest rate movement. A small rate shift can make your high-yield investment far less profitable overnight. In 2025's unstable environment, volatility is the biggest unseen cost. Chasing yield in uncertain conditions can leave you with losses larger than expected gains. Smart investors focus on balance, not speed, especially when markets keep shifting. 8. Hidden fees and complex structures. High-yield investments often come wrapped in complexity-layered funds, exotic derivatives, or offshore vehicles. Each layer can hide management fees, performance cuts, or limited transparency. Even when returns look strong on paper, hidden costs silently eat into profit. The wealthy avoid such traps by demanding full clarity before committing. When complexity replaces simplicity, risk grows silently. Always ask where the yield truly comes from. If it's unclear, that's your warning to step back. 7. Liquidity lockdowns during market shocks. Many high-yield assets come with lockup periods or withdrawal restrictions. That means when markets crash, you might not be able to access your money. Investors often underestimate how dangerous illiquidity becomes during crises. A paper gain means little if you can't cash out. In 2025, with unpredictable global shifts, flexibility is worth more than a few extra percentage points. Smart investors choose investments that can be exited quickly, not those that trap their capital when it's needed most. 6. Credit and default risks are rising fast. High-yield investments often rely on lower credit borrowers or risky institutions. When the economy weakens, those borrowers are the first to fail. Defaults are rising globally as debt levels remain unsustainable. Investors chasing yield from corporate bonds or private credit funds must remember, risk doesn't vanish just because it's packaged professionally. The higher the promised return, the higher the chance of loss. In today's environment, chasing credit risk blindly can cost you your entire investment base. 5. Inflation can erase your real gains. Even if you earn 8% annually, inflation running at 6% means your real gain is just 2%. Many high-yield products don't account for the silent erosion of purchasing power. Investors focused only on nominal returns often miss this critical reality. Inflation eats quietly, and by the time you notice, your wealth's true value has already shrunk. The rich protect against this by diversifying into inflation-hedged assets, not by chasing the highest headline yield that looks good only on paper. 4. Emotional traps of greed and FOMO. The human brain loves quick wins. When everyone else is investing in high-yield products, it's easy to feel left behind. But that emotion, fear of missing out, drives poor decisions. Greed blinds rational judgment, pushing investors to overlook risks they'd normally avoid. High-yield markets thrive on that emotion. True financial mastery means recognizing that patience builds real wealth, not rushing after returns others claim to be making. Discipline, not desire, separates the winners from the lost. 3. Market cycles always catch up. Every high-yield boom eventually hits a correction. Whether it's real estate, crypto lending, or junk bonds, no market escapes gravity forever. Investors who chase peak yields often enter near the top of a cycle just before the decline. Timing becomes the silent killer of returns. Those who survive cycles understand that sustainable profit depends on risk management, not on excitement. In 2025's uncertain climate, knowing when not to invest is just as valuable as knowing where to. 2. Overexposure to one risky asset. Chasing yield often leads to poor diversification. Investors put too much capital into a single high-return asset, hoping it outperforms everything else. But when that sector crashes, so does their portfolio. Diversification isn't exciting, but it's the ultimate protection against loss. The wealthy spread risk across asset types and time horizons. High yield is never worth it if it threatens your entire foundation. A slow, balanced climb always beats a fast fall. 1. The long-term cost of short-term thinking. Chasing yield is almost always short-term thinking disguised as opportunity. It ignores the bigger picture of consistent compounding and capital safety. The world's richest investors didn't build wealth overnight. They built it patiently, protecting their downside every step. Every financial decision should ask one question: will this still make sense in 10 years? High-yield temptations rarely pass that test. True investing wisdom lies in endurance, not excitement. High-yield investments are not inherently bad, but they demand clarity, caution, and discipline. In 2025, when uncertainty defines the markets, chasing yield blindly is one of the fastest ways to destroy wealth. Focus instead on stability, risk control, and long-term growth. Because in the end, real wealth isn't about how high your returns go, it's about how much you keep. If you found this helpful, hit like, subscribe, and stay tuned for more insights that protect your money and your peace of mind.